Hello and welcome. Today, we're doing something a little different. We're putting a company, Dynacons Systems, on the examination table for a full health checkup. We're going to use the analysis from Web Cornucopia Finance to break down exactly how the pros figure out if a company is truly healthy or not. Let's get into it.
Okay, let's start with a simple number, 485 rupees. Back in July 2025, when this report came out, that's what one share of Dynacons Systems and Solutions, or DSSL for short, would have cost you. Just a number on a screen.
And this is the real question, isn't it? This is the engine that drives all stock analysis. It's not about the price tag today, it's about figuring out what the company's health, its vitals, and its future tells us it should be worth.
So, let's formally introduce our patient for today's checkup, Dynacons Systems and Solutions Limited. Before we can check its pulse, we need to know exactly who we're looking at.
So at its core, DSSL is a mid-sized IT services company. You can think of them as the tech specialists that big companies call in to modernize their systems. They're all about something called digital transformation, providing the software and the brainpower businesses need to compete, both here at home and around the world.
Now, before a doctor checks your vitals, they usually ask about your lifestyle, right? Your environment. Well, it's the same for a company. We need to look at the health of the entire industry it operates in.
And let me tell you, the environment for DSL is thriving. The report calls these positive industry triggers, but you can just think of it as the perfect climate for an IT company to grow. Businesses are rushing to the cloud, demand for software is through the roof, and big government pushes like Digital India are just adding more fuel to that fire. It's a really good time to be in their line of work.
Okay, so the environment gets a big thumbs up. Now it's time to put the stethoscope right on the company itself. We're going to check 3 key vitals from the report: its stamina, its efficiency, and its overall strength. First up, stamina. In business, that means revenue growth. And wow, this chart says it all. DSSL's revenue has been growing at a compound annual rate of over 22% for 5 years straight. That's not just a steady jog, that is a powerful, consistent sprint.
But, even the healthiest patient can have a little note in their file. For DSL, the report points out that a lot of this amazing growth comes from just a few very large clients. It's a risk factor, something analysts call client concentration, and it's something to definitely keep an eye on.
Okay, next vital sign, efficiency. And we measure this with a fantastic metric called return on equity, or ROE. Put simply, ROE answers one really important question. For every single rupee that investors give the company, how much profit does it manage to squeeze out each year? And DSSL's number is 18.5%. Now, a number like that floating in space doesn't mean much, does it? Is that good? Is that bad? To figure that out, we need some context.
And once we get that context, the picture gets a whole lot clearer. At 18.5%, DSL is actually a little more efficient than its average competitor. It might not seem like a huge difference, but in a tough industry, even a small edge in efficiency really matters.
All right, our final vital check is strength. And the best way to think about this is to use the debt-to-equity ratio, which is kind of like a body fat percentage for a company. You need a little, sure, but too much can be really unhealthy. Lower is almost always better. And DSSL's number, an incredibly lean 0.15. This company's not being weighed down by a lot of debt, which the report calls excellent.
So, we've gone through the patient's history, we've checked the environment, and the core vitals look strong. Stamina, efficiency, strength, all looking good. So now it's time for the big one, the final diagnosis. What is this company really worth?
Right. How do you actually put a price on the future? Well, one of the key tools is called a discounted cash flow analysis. It sounds complicated, but the idea is simple. 100 rupees in your hand today is worth more than a promise of 100 rupees a year from now, right? DCF is just a way of taking all the profits a company is expected to make in the future and calculating what they're all worth in today's money.
And they don't just guess one future. They model a few different ones. You've got the bear case, which is the pessimistic view. The bull case is the super optimistic one. And then you have the base case, the one they think is most likely to happen. They even assign probabilities to each scenario. And here's the bottom line. According to the report's most likely scenario, that base case, the fair value for a share of DSSL is 520 rupees. That's the analyst's official diagnosis. And remember, the price was 485. So this suggests there could be some room to grow.
Now, after all that work, analysts love to boil everything down into one simple score.
Web Cornucopia does this with their own scoring system. As you can see, they take everything we've talked about, financials, growth, how it stacks up to competitors, and they weigh each part to come up with one final grade.
And that final score, the overall health rating for DSSL, is a very, very solid 7.6 out of 10. So, the professional diagnosis? This patient has a clean bill of health. So, the checkup is complete. The score is in. What are the doctor's final orders? And, just as importantly, what are the potential side effects an investor should know about before filling that prescription? The report is very clear on this. Based on all the analysis, the final recommendation is a buy, and they're setting that target price right at the fair value we just saw, 520 rupees. But of course, no investment comes without a warning label. The report flags 4 key side effects to watch. There's that dependency on big clients we talked about. There's intense competition from bigger players. There's the challenge of finding and keeping the best tech talent. And of course, if the whole economy slows down, IT spending is often one of the first things to get cut. So at the end of the day, our checkup shows a healthy company operating in a great environment. The real question going forward isn't if Dynacons is healthy. It is. The real question is, how will it manage the challenges that come along with its own success?